All right, Sherman, we are live.
Okay,
Hello and welcome, everybody. I'm Dr. Richard Smith. I'm the chairman and CEO of the Foundation for the Study of Cycles, a position I am beyond honored to hold, and very excited about what we're able to bring everybody this week, starting with my good friend and longtime foundation supporter, member, driver, Sherman McClellan. Sherman, thanks so much for joining us today.
you're welcome. We're glad to be here.
And you were just mentioning that 1980 was about the first time that you presented to the foundation audience.
In the 1980s, yes, when they were located in Irvine.
So just in case anybody doesn't know Sherman, this is Sherman McClellan. Sherman and his son, Tom, run the McClellan Financial Report at mcoscillator.com. Sherman and his wife, Marion, mathematician wife, I might add. I say that affectionately because I'm a mathematician too. So developed a number of incredible indicators back in the early days of technical analysis, which have now become staples of technical analysts everywhere, and are called the McClellan oscillator, amongst other indicators as well. So very excited to have you with us, Sherman. And anything else that we should be telling our audience before we get started?
Well, when one of the things that I got for Christmas from my wife was a set of chart paper and a commitment to do some calculations for me. So as a result of that, we had the McClellan Oscillator and Summation Index were born in 1969.
1969. That's when you first. They didn't
So
have a lot of computers.
That's when the oscillator and summation were developed. I have all of the issues of Barron's Market Laboratories since January 1st of 1968, and I have most of the complete Barron's, but some of them are missing. And that data then got inputted into computers when personal computers came into vogue in the 1980s.
Yeah.
And we started with VisiCalc and graduated to 123.
Which you're still using today, right?
We still use an old version of 123 because of the graphics. The graphics are better than what Excel has.
I envy your graphics, and I was sad to find out that you were using Lotus 123 to do your graphics, because I don't think I can even get it to run on any of my machines anymore. If I understand correctly, you have a special computer that still runs Windows XP, right?
We have to graduate to Windows 10 32-bit systems in order to be able to run it successfully.
Oh, man.
So now we're migrating. We also have the 64-bit system in 123, and we're gradually improving to graduate to that system yet.
All right. Well, welcome. And why don't we get started? Can you share your screen?
All right, we'll do that.
I will be in the background mostly. I might chime in with a question or two from myself or from the audience, but Sherman, take it away.
We should be on the first set of screen there.
Looks good, yep.
We're going to talk about cycles and the pandemic prices, and we're going to see that different commodities and indices have responded differently to the pandemic, and so we're going to point some of that out. And the first thing that we want to show, if we can get this to work properly. Well, I'm stuck on that. All right, we'll do it this way. There's 3 ways to anticipate future price action. There's cycles and cycle analysis was constructed using some very long-term cycles, and so it would not have included some of the shorter-term cycles that would be active in creating the actual tops that came in ahead of those lows.
So this is why many of us remain so fascinated with cycles. That, yes, it's sometimes hard to catch tops, and cycles don't always work, but sometimes they just work like magic. I mean, to be able to do that, more than almost 2 years before a major bottom is extraordinary.
It is extraordinary to see this. It was created, and this is from a file that I received at that time as I was working with the foundation on some programs. Now this next chart that I'm going to show was created by me, but it was created at the March meeting of the West Coast Cycles Club, and I do a presentation there at the end of each month. And so this was created around just before the end of March of this year to show what was expected. And this is typical of the charts. You'll see over here a little red triangle on the left corner, and that's the date of the last of the data that's used to create this forward-looking cycle. And so this was using data up until June 30th of 2019, and it picks up the top is in January, and another top in February, and the bottom coming in on the 324. And so this could have been looked at as soon as you had data up through June of 2019. June 8th, and we've been in consolidation since then. This little star is typical on the charts that you'll see today, and that represents the current pricing level of the particular index that's shown. These charts were made some time ago, and so there's not up to date. This calls for a top around October and a bottom around the end of November, the end of December. And down in the bottom, you'll see where the particular cycles that were chosen, and they were chosen because of the buy-sell percentages were good for profit.
Hey, Sherman, can I jump in for just a second? A few people
Sure.
had trouble hearing us when we first started. So would you mind
like
going back a few slides and just show that super bear slide again? Because I want to make sure everybody got what we were looking at there. So just to reiterate, this was a chart that was put out by the foundation in late June, early July of 2018, forecasting a bottom to a bear market on March 18th of 2020. Okay.
And not just a bottom, but a super bear bottom.
A super bear bottom. And then now, admittedly, the tops, didn't work, right? But the bottom forecasted on January 14th, 2019, a bottom came in about 6 trading days out of that. And then, of course, the bottom on March 18th, 2020, forecasted, 21 months before this happened, it hit within 3 trading days. So just go to the next slide.
From Wednesday until Monday.
And we missed it by 2 days.
Missed it by Thursday, Friday, Monday.
The next slide, this is showing what actually happened after that forecast was made back in July of 2018.
So it missed the low by 6 trading days in January of 19.
Yep.
The market carried on a little bit beyond the June high, but the projection properly constructed or showed that the market should be rising between January and June, and that was what did happen.
Right, and it did. Amazing. Okay.
And then 3 days off the bottom in March.
And folks, we may have some technical glitches along the way, but we are delivering this content for free via a YouTube live stream. If you do get any glitches, bear with us. Let us know in the YouTube chat. We're dealing with it. We got some wonderful support staff, and we're thrilled to be able to bring this to everybody on this incredible technology. So thank you.
Now this forecast shows a rise off of that March bottom, and it doesn't show beyond around July. And so we are going to delve into what might be happening beyond this March bottom and for the next period of time, next year. So we're going to explore some of that as we go forward and see if we can do a projection for what might be happening or what we ought to look for later in the year.
Love it.
So this forecast shows a bottom on March 24th. It was a day off. It called for a top on June 8th. It came in on June 8th pretty closely, and it shows that we should have a consolidating type action and all the way out into August with a pretty good rally in July with this wiggle, and then a top out here in October at the end of the fiscal year for the country.
And if I may, just to be clear with the audience, this forecast was made back in July of 2019, right? So that red triangle in the bottom corner.
The red triangle shows the data used was prior to June 30th of 2019.
Right, and it's used with an older product that the foundation used to offer that you still use. But we have a new product that's cloud-based and online now that does similar forecasts. But this was done with TechSignal 9, which is an older version of the foundation's technology. And
we're going to even show you how you can do your own cycle analysis at the end of the program here. So we're going to roar through this and see what we got to show for a whole bunch of different commodities so that you can see how they behave differently from each other and from the way the pandemic played out. And the 800-pound gorilla is the Fed. And so it has an influence on some areas and not on other areas. So here's another projection that was using data up till the end of the year of 2019 and changing it by 6 months from the previous chart. You still wind up with a March 24th low, a day off from the actual bottom, but it shows the top being at 622, which is today. So we'll see whether that, how that behaves as we go forward, but you won't see it here. You'll have to do it in real time yourself. But it does show a bottom toward the end of the year and then a rally up until the end of the first quarter, maybe into the second quarter. And we've labeled that a top. So all the charts that you'll see today will say top up here because this is what was projected on this particular chart and on some others that we'll show also. And then this one, this is the same kind of analysis, but it used data up through the pandemic decline and used data through March 31st. And it shows a little later bottom coming in on the 27th and a little later top on July 2nd rather than on June 8th, and a very wiggly market and a top right around election time, and then a decline into the end of the year. And this again, it shows this top again coming in around the end of the first quarter.
So again, like as more data accumulates, we're able to kind of refine the forecasts, right? And you see them shifting around a little bit, but still maintaining a lot of similar structure with kind of a high in late June, early July, correction or kind of stagnation, a high towards the election, correction, and a high into the spring of 2021.
Now we're going to look at another way to look at how to deal with forward-looking material. This is a view and chart created by my son Tom, and as you can see that the log scale of the crude oil price and the log scale of the Dow Jones Industrials have quite a similar construction. And he noticed that this looked fine, but maybe if we move the crude oil forward about 10 years, you got a better alignment because that 1920 top on crude aligns with the 1929 top in the market, 1942 bottom and right in the war aligns with the 33 bottom.
Can you show those dates with your cursor, Sherman?
1920 versus 1929, the tops align. The 1933 bottom aligns with the 1942 price bottom during World War II at the Battle of the Coral Sea, and then a rally up until around 1948, and this was up to around 1957, 58, and the Korean War interfered with some of that. And then a very flat horizontal period on the crude oil until the early 70s. And you see why a very flat horizontal behavior on the Dow. It took a long time to break it out above that 10,000 level. And then with the 82 bottom aligning with the 1973 bottom, we see a big rally on the Dow in accordance with increasing prices on the crude. There was a big whoop-de-doo here with this 2008 top, and we had a pretty good decline as a result of that in 2020. And now the projection is for something to top out around April of 2011, projects to around April of 2021. Lo and behold, that's around the first beginning of the second quarter of 2021. And that's where we saw some of the cycle projections that we'd created before. And
so thank you so much for sharing this one.
It has a lot of problems and congestion for quite a few years.
Yeah.
And then we can look at it more tightly. And then around 2024, it looks like there might be some problems based on price of crude oil if there is a problem. So
somehow crude oil forecasts the stock market 9 or 10 years before it happens.
Yeah, it doesn't, not the amplitude, but the dance steps.
Yep. And it's forecasting a high probably around the spring of 2021 for the Dow.
And we did see a big decline into December 24th, 2018, right on schedule with this. We see the top here and then some decline, and we're in this period of decline and sideways congestion here until later in the year, and then we run up into the top. Nice. So we'll look at how that might develop. There's concurrent patterns also. The advanced decline line for the New York Stock Exchange, and it was making new highs into February ahead of the decline for the pandemic. And it's now, of course, recovered to new highs. And so the liquidity that the Fed is injected into the economy and into the market and into the financial sector, it shows up as being a very liquid market and above this red 10% trend all the time. And
so this is showing that on the New York Stock Exchange, there are more stocks going up than going down on a daily basis.
Now, when we look at the daily volume line, it made its high in January. And of course, that was one of those cycles highs that we showed was around the middle of January. That's and this was in the middle of January. And then we had a lower top in February. And the divergence between the volume not going to a new high was a tell that this market was in trouble. And we were able. The volume.
If we can share with the audience what you and I talked about yesterday. So, broadly, the number of stocks going up was greater than the number of stocks going down, but the volume was starting to shift towards the down stocks instead of the up stocks. Is that basically what
The
you saw?
advanced decline line shows liquidity that's generally available. The volume line shows the willingness of investors to hold stocks and to buy stocks and support present price schedules on stocks. And so when it's behaving differently, as you can see, each time we had a rally, we made a higher low and a higher high and a higher low and a higher high and a higher low and a higher high and a higher low, and then we made a lower high. And this says things are not happy because the advanced decline line was making new highs, and this was not confirming.
And just this is the heartbeat of your work and the McClellan financial report, right? Using market breadth to really get a sense of liquidity in the markets. And you don't go anywhere without this. You don't use cycles.
This is the basis for McClellan oscillator and summation index.
Yeah.
And I want to show you a little bit of interesting behavior because this jumped up off the bottom in 3 days above the 10% trend and then consolidated. And then it jumped up above the 10% trend and consolidated. And then it jumped up above the 1% trend and consolidated. And then it jumped up above the 1% again and held there and then ran to a new high and then consolidated. So now we're in this consolidation structure, and it probably will last a little while longer than some of these others because we've topped out summations and price oscillators, and we need a bigger correction at this time.
But you're still seeing tremendous underlying strength in terms of.
But there's tremendous strength, and if we were going into a bear market, we would be below this 1% trend, and we would not been able to get above it. And both the AD and volume have gone above it. So we see plenty of liquidity and not any problems yet, as long as the Fed and its 800-pound gorillas are behaving well, we'll have a market. And if they stop, the music stops and you look for the chair to sit on.
Right. All right.
So we're going to go through some of these different charts and we're going to zoom through them. And I've shown 3 different charts for each one because you, I think, need to see some of the busier charts and you need to some that are not so busy. And so that's what we'll be looking through here.
So as we go through the first set of charts, Sherman, let's just explain a little bit about each chart so people get a sense of what's on each chart, what's telling them. And then I think as we go through the successive markets, we won't have to kind of highlight those over again.
Let's go through and see. All of these charts start with data from May 23rd of 2019. And so the black line is the price of near month T-bonds. The little red triangle down here is at December 31st because all of the data that was used to break this cycle projection is to the left of that little red arrow. And all of the projection is to the right of that.
Yep.
So the orange line that's a little bit longer is the cumulative total, the synthesis, it's called, of all of the cycles that go into the making up. So you have 1, 2, 3, 4, 5 cycles that make up the synthesis, and it shows where all of these, the cumulative total of all of these cycles are how are they behaving.
Right.
So you'll see a star that is roughly approximately where the price is. And you can see that we had the pandemic decline into February's bottom, and the Fed has come in and supported it. And now we're just going horizontally across at this level.
So the Fed is disrupting the cycles.
The Fed has seriously disrupted the way this cycle would have behaved if they had not been active in the market. We would have seen a large decline here, and that hasn't been allowed to take place because of the fundamental conditions that they've imposed on the market.
Right.
So this shows a top out here around this second quarter, beginning of the second quarter in 2021.
So, and that top sign that you have just marked on the chart is showing kind of your best sense of where the market
That's
top
my sense of
spring of 2020.
after that time, we're going to have problems. And we're going to have problems because of the projection from the price of crude oil. We're going to have problems because of the cycles that show that there's going to be some problems there. And so you have the foundation has picked up the cycle bottom in March, but they didn't tell us what's going to be happening beyond that. And so I'm going to try and give you some projections that show that maybe we're going to have some problems. Now, the other point would be that the election is around the first week of November, second of November, third, something like that.
Yep.
And that's about where this is November 24th. So it's ahead of that, about in this area here. So you can see how that relates to where some of these cycles.
Yeah, and I just want to reiterate one more time, it's great for people to see this because this is a basic cycles analysis. You detect the independent cycles and you've got a lot of squiggly lines there of different lengths, but they're sine waves. They're just, equal. And then you add them all together to get the cumulative or the composite cycle forecast. And that's, you see the red line or orange line that's got more wiggles in it, right, than just a regular sine line. You can see the cycle lengths in the top left of the chart there, 76.2, 36, 141. But this is how a cycles analysis is done. You find your best cycles, you add them all together, and you plot it against price. So
this next chart shows the particular construction that was done. That they are based on this buy and sell percentage. In this particular cycle analysis program, you can see which the best cycles were for making a profit going both ways. And since I trade both ways, I wanted to include that. And so I've chosen, in this case, the first 5 cycles. Some we use 3 or 4 or 5, 6 cycles. I hate to use more than 6 because it's such a cluttered condition on the chart.
Right, and I think this is a really important point because not everybody does cycles analysis this way, but you are picking the cycles based on which ones have been the most profitable. If you bought at the cycle bottom and sold at the cycle top, and bought back at the cycle bottom.
That's right.
So that's what your metric is, which is great.
And this allows you to analyze it on a buy and hold or on a only sell. And it gives you a phase and a signal and the amplitude. So there's quite a variation on the amplitudes. It varies from 463 down to 44, up to 97, 265, and 41. So these different amplitudes are shown up in the wavy structure and height of amplitude on that particular cycle.
So we have one question from a viewer asking if this involves Fourier analysis. And it does involve Fourier analysis to kind of do the initial detection of the cycles. But then there's different ways of selecting which cycles you want to focus on and make your cycle forecast based on. Right?
The Edward Dewey and Gertrude Shirk did their cycle analysis when they were starting the foundation in the 1940s by hand and with calculator, Freedom calculators later. And they decided on a trend, establishing a trend for each of these price structures, and then doing the cycle analysis on the deviation from that trend. So this particular cycle analysis program uses that method.
And again, these cycles are based on data only through the end of December 2019. So what you're seeing there for 2020 was forecasted, well before those events actually happened. And it did catch the top in the T-bonds pretty well.
It caught the top very well, caught the bottom of this very well, caught the top of this very well. It did not allow, the Fed stepped in and did not allow this to happen.
Right.
And so now we're catching up with this. We're almost to this little top here. We have a little decline topping here. we have advancing, but it does show this top around the beginning of the second quarter of 2021.
Great. Okay.
So here's Dr. Copper, and you can see what it looks like. It did respond to its proper cycle, and it had trouble getting a bottom because the cycle called for a little lower low, and it's below all of the trading, and we've had this advance into this point here, and then it shows even more advance later in the year. It doesn't. It shows a top. A top is equivalent to this top over here, so there might be something more going on later in 2021, but it does show a top coming in at the appropriate time in our estimation. And the Fed has influenced this to some extent, but it's not at new highs like the bonds are at currently.
Mm-hmm.
And here's what the cycles look like. This has quite a strong cycle that has some very high amplitude. That's that 221-day cycle. And so you can see the wiggles around because of that. And here's what the synthesis looks like.
So copper up into the election.
Yeah. So gold has been helped greatly by the Fed, we think, and by the pandemic itself, and the action of prices on other assets. So it did pick up the top properly and over here in 2019, and at the bottom, that is where the advance started, and properly shows a dip in the middle, which we got, and then the Fed is not allowed this to take place with a bottom, so we might there's a seasonal factor on gold for around making low around August, and so we'll see how that pans out. But it does show topping structure around the end of the first quarter, beginning of the second quarter, 2021.
The Fed probably isn't intentionally looking to prop up gold.
I don't think they want to prop up.
Inadvertently, it's like when you're going to print that much money, those of us who value sound money think that could be good for gold. So
these are the cycles that were used. And there's one large cycle amplitude, that 147-day cycles, 746, and then another one on the 126-day cycle of 428. So there's some fairly large amplitude cycles that are at work on this particular commodity. I may call it a commodity.
Yeah, and the fact that gold hasn't really, corrected into this down cycle is pretty striking. It shows a lot of strength that you have to respect.
So it did of course respond to the pandemic. What happened? I hit the button wrong. So here's this is what it looks like on the synthesis, and here's soybeans. And our family has some history of farming in the Midwest, and I ran a farm for a few years in the 1960s. And so I have an interest in following some of the commodities of corn and oats and soybeans and that kind of thing. So it's low with the pandemic in March came in, but the cycle said, no, we have a lower low. And lo and behold, that did come in as some of the conflict between China and the US over trade policies and some of the problems with actually doing trade and shipping because of the pandemic. There basically shut down some of the normal shipments of farm commodities between the US and China and other countries.
I just want to point out this forecast was made with data that ended in December of 2019. So that's a pretty good forecast of soybeans, made 6 months before today.
So we're coming in toward a little top here in July, and then harvest time would be around in October. So this is a normal cycle low, and then popping out later in the, because it's on a different schedule, then it's not necessarily affected by the Fed. And so it doesn't show the same topping structure at the end of the first quarter.
Right.
So here's the cycles that were used. And here's what the synthesis looks like. Top did come in, the bottom has come in. We're in this upward cycle, and then we have some decline into harvest. So this looks like we should have a very good harvest and lower prices at harvest time. This is Kansas City wheat because that's the wheat we follow. And you can see the cycles were pretty good for the top over here. The advance into a top here, and it did honor this bottom and is back increasing. There's the cycles that were used. And this is what the synthesis looks like. This does show
cycle inversion there, where it goes up when it was supposed to go down.
Well, you know, this is harvest time for wheat. So this just came back down. There was some international issues with wheat in other growing areas, and so it had this little rally with this whoop-de-doo here.
But I think this is a really important point, and I'm sure you know this, Sherman. You know, like when you see the cycle, for example, perform so well from December of 2019 through to March of 2020, you can start to get kind of mesmerized by them, right? And then all of a sudden, you know, it stops working. And
well, you know, this is the pandemic bottom, and it came in on schedule, and then it bounced.
Yeah.
And it shouldn't have bounced, and so it came back and honored this other bottom.
It's very important to me throughout this whole week of looking at phenomenal cycles results to remind people that, you know, they work like magic sometimes, and sometimes they don't work. And, you know, I don't think you use cycles just by themselves, trading them outright, correct?
Never. No, you have to use other tools to be sure that what the cycle says ought to be happening is really happening, because the cycles just say what should be normally happening, and other things than normal, like the Fed, like government regulations, like income tax changes. There's all kinds of things, other regulations that can affect. You can have shipping problems. You can have ice on the rivers and lakes that affect shipping. You can have lots of different things that can happen.
Right.
This is corn, and it shows that has not recovered. The bottom, of course, was here at the pandemic bottom in March, and it's continued on down as it should with the cycle development. And it's had a little bit of rally, but not much. And then it shows after July, we should probably have a more important advance in corn. And this might go along with returning to a more normal shipping schedule to China, and a more normal output of corn in relationship to the agreement between the US and China. And this is what corn looks like and what the cycles that were used.
So this is the same chart. You're just showing the cycles.
Same chart. This is the synthesis, and showing that it does show that the bottom would be in around February or March, which is a very typical low period for the price of corn, and then upward out of that. Coffee, it's near its lows from last year, and is not. We did not get this upward cycle movement that was expected here. So this is a case where the cycle did not perform particularly well, and indeed the cycle bottom was at the end of was in January, and we were having a cycle top. So there is some inversion taking place here between where the cycle says there should be a bottom and we're seeing price tops.
Yep.
This is not always the case with it. It looks pretty good over here in last year.
Mm-hmm.
So it may come back and we will see maybe some increase in prices as we get in through the summer here. And here's what it looks like with the synthesis. Cocoa, not much to see about cocoa. It did have a low and along with this and ran up to a top where it should have, had a decline into a bottom, but it did not perform well with this decline and is basically gone sideways at a very low level. So it's not behaving the way that the cycle says. Crude oil is, of course, much more important for what's going on with the price of the Dow and other indicators. And crude oil did bottom in March when it should have, and bounced and then came down to honor this cycle bottom that was projected. And now it's going up and should really continue up until the end of the fiscal year for the if this cycle continues to hold. We've gone up, we had a gap around here at the 40 level. We've gone up and closed that gap, and we're bouncing around trying to trade between this top and that bottom. And we'll probably do that for a while here.
It's interesting how in crude, there's a lot of small cycles and there's one long cycle, right?
Yep. That's
so
what,
that blue cycle
that's
there
what we see in this.
Like 307-day cycle.
There's one
days. So that's
800-pound gorilla amplitude of 1230, and all the others are 58 and 25 and 192 and 155. So there's one big 307-day cycle that dominates this whole crude oil picture.
Yep.
For this particular construction of buy-sell construction. Other ones would pick different cycles. So yes, when you do cycle analysis, you can be a statistician and get sort of what you want. Heating oil.
Our next guest, Larry Williams, is joining us. He's going to be on after you, so take your time. I'm just going to let him in, but we'll carry on and finish up in about 15 minutes.
We'll run through the rest of these. Heating oil has not performed well. It's way behind crude. Crude's up in here in relationship on this chart, but heating oil is not. But it's going to have its low seasonally in the late summer, and then as winter comes along, you'll see higher prices of the crude oil. I mean, the heating oil. Utilities has a very different picture from anything else in terms of the cycles that were picked to look at, and it's done a pretty good job of doing cycle analysis, but it's a much shorter period of time that's involved in looking at them. And there's only 3 cycles that were picked because those are the 3 strongest cycles. So
yeah, those are really short cycles, quite a bit different than crude.
Yeah, quite a bit different. So it has a different look than most other things.
But look, I mean, they work pretty darn good.
But there's your top.
I'd say.
Here's your bottom. It came in. Here's a top. Yeah, here's a bottom. We're up near the top of this thing. It happened. And we're seeing interest rates declining right now, and that would be in concurrence with what utilities are a yield instrument.
Yeah, great.
Transports are very interesting to me because this top in the middle at the end of this is the end of the fiscal year, and there's been support for the airlines through the end of the fiscal year to give them some props. This says maybe there isn't going to be too much support for them after the end of the fiscal year, And so that might be a little bit of a problem, but it does show that
it has the same 307-day cycle that crude oil does. Did you notice that?
Yeah,
Dominated by the long cycle.
they do use a lot of product to get to where they want to go.
Yeah.
And here's the transports and shows what it looks like. Now, it's not showing a top at the end of the first quarter. It's showing, hey, these transports are not doing well. And when you have a transports not doing well and the Dow doing well against it, that's a big Dow theory problem.
So that kind of supports the thesis that we may rally into the spring of 2021, but watch out after that.
That's a possibility. So we're going to be following that and taking a look at it. Here's the top in the Dow Industrials. This shows a low around September. That's not too unusual. And here's where we are. We're not at the highs. And we're picking up this little top here, and then we're going to have some issues. More consolidation time, looks like. NASDAQ was at a new high. It's made its new high, and it's done it counter-cyclically. So that's sort of interesting.
Yeah.
And it shows a top at the end of the year rather than in the end of the first quarter. So it shows topping ahead of maybe the market. This is a NASDAQ composite.
That's the same cycle that you're showing on the first page, just clean and not cluttered by the component cycle.
Yeah, this is the synthesis of all of these cycles over here.
Right.
But it picked up the bottom pretty good here. It picked up the top. It was a little bit late, and the bottom came in, and it's a little different. New York Composite is also recovered, but it's also showing that it's not very strong on the composite cycle, and we're not very interesting until out of the September into the election. The S&P 500 has a little different look to it, and it shows that we should be going up into August, and then a drop toward the, this is about where the election is. This is Thanksgiving, and the election would be right about in here. So it shows a drop ahead of the election. And then I've put that on here, and you can see where the top comes in at the end of the first quarter. Now, this Foundation for the Study of Cycles has on its website this cycle scanner program, and you can program it, and it has choices of various cycles you can choose. And for this particular chart, I chose these that are in green, and it has a dominant cycle showing of 171 days, and that's this 171-day cycle feature. And the green says these are the best cycles, and these green and that green and this green are the best cycles. And it shows you where those cycles reside. The blues are a little bit better, and they're in the middle, and the red is not quite as strong as the other ones. So this is the cycle projection. This is what it looks like when this cycle analysis was done, and it calls for a top here around August and a decline. The election this is the beginning of November, so the election is right about there. And so this shows a decline into ahead of the election.
Yeah.
This is join the foundation and create your own cycle analysis. And you can use that cycle program to analyze things you want to do.
Yeah, right here on the area below the YouTube presentation, If you click on show more, you can see a couple links to become a member of the foundation or make a donation to the foundation. Sherman, I just want to kind of highlight some of the things that I got from your presentation. So really, I think you showed, that sometimes cycles forecasts can be absolutely astonishing. So like forecasting a bottom in March 18th of 2020, way back in July of 2018, like, I don't know how that happens, but it happens, right? I mean, you've seen it before, yeah?
I have.
And I think a lot of the cycles forecasts that you showed also had some very remarkable results. Agreed?
I had a printout of that chart pasted onto my uh, 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 bookcase so I could see it.
Yeah, and you've been at this 50 years, or more. You've seen a lot of different things, and yet, you keep coming back to cycles.
We've done a lot of work with cycles, and you do need filters so that you can be sure that the cycle is actually coming in. And when you do that, you have really a good capability of understanding what's going on with the market, or that it isn't going on with the market.
And overall, what I saw you talking about, at least for the US stock market, some ongoing support, including from your own breadth indicators, probably into midsummer. Some kind of correction likely before the election, maybe a rally into the election, and ultimately a rally kind of into the spring of 2021. But then,
we see the Fed continuing to try and support the market. They try not to be political. So it seems to me that they're going to try and support the market going into the election so that they can't be accused of anything nefarious. And after the election, they will be no longer under that restriction. And so there may be some problems at that time. So that's what we'll be looking for based on what these cycles might be telling us.
And one of the questions we got from the audience was, how long do you think these artificial, influences are likely to go on? You think it's through the election yourself?
It seems to me that if they end it before the election, they will be accused of interfering with the election. Mm-hmm. And it will be very difficult for them to do that politically. So I don't, if they do it, whenever they end it, the history is that when quantitative easing ended on each of the quantitative easing programs, that this is the fourth one now that they've had, the first three, at the end of them, there was a very large correction, more so on QE1 and QE2, and then they learned that maybe they better taper it off. And so, but there still was a correction at the end of QE3. And so we're expecting that because of the huge distortion that they've induced into the liquidity stream for the economy, that there'll be a pretty huge correction out of it at the point where they end their QE4 program.
Great. I think we will, let's see if there's another question or two. How much do cycles correlate with seasonality, in your opinion?
Well, you're going to have some other people that are going to be much more up on seasonality.
I think our next speaker, Larry
Williams, you're going to have to stay tuned and watch Larry Williams and some of the other people that are much more up on seasonality. So you're going to see some. This is only the beginning of this program series, and so we're just trying to give you a little background on cycles and how they work and how they don't work, and you're going to see a whole different picture with all of the different people that Richard Smith has gotten lined up for this particular series of programs. It's great. I lost your sound.
Larry, are you there?
Hey, good. Thanks, Richard. Sherman, great to see you.
Good. Glad to see you now.
Yeah, I wish I could afford a camera like you guys. You'd be able to see me, but I don't have a camera on my computer.
All right. Well, Sherman, thank you so much. Thanks for kicking us off. That was a great presentation. I learned so much, and I know we delivered a lot of incredible content to the audience. So thank you again, and thank you for your support of the foundation over the years. I really wanted you to kick this off for us because you've been so instrumental in the foundation even still existing today. So thank you and appreciate it, and hope you'll stick around and enjoy some of the other speakers and presentations. All right. Bye, Sherman.
Bye-bye.
All right, Larry.
Okay.
You can share your screen, and Sherman, you can, if you turn off your video, that'll help too, and mute yourself. And if you want to listen in, great. So, Larry, welcome. So happy to have you with us. So honored that you are joining us. I know you've been a great supporter of the foundation over the years, and we've been talking off and on over the past year as we've gotten the foundation kind of back on its feet and ramped back up. So we have a lot of people on a live stream on YouTube right now. We've got people signed up for this event all over the world. And I'm sure most everyone knows who you are, Larry, but much like Sherman, you've been in this business for 50 years, literally taught thousands and thousands of how to invest in the markets, won trading champions yourself, taught your daughter how to trade, who won a trading championship, and board member of the National Futures Association, author of dozens of books. So it is great to have you here. Very excited about what you have to share with our audience today. Thank you.
Great. I've been looking forward to this. Just checking, Richard, can you see my screen? Is it showing?
Yeah, I
okay,
see,
cool. Okay, good. Okay.
The good, the bad, and the ugly.
If there are questions, do I see them or do you relay them to me?
I will relay them to you.
Okay.
You won't see them because they're on the live YouTube stream,
Got
so
it.
it's not actually in Zoom, which you and I are on. But
Okay.
I will be collecting them, and I'll probably jump in once in a while if that's okay. Or would you rather me save the questions till the end?
No. As they come, it's probably best so we don't have to go back and forth from wherever the questions come.
And you don't mind if I jump in with a question once in a while too?
Yeah, absolutely. Absolutely.
Okay.
I think that you did something wrong though with this seminar. I think you should have played some Lawrence Welk music because you got Sherman and Larry Williams. This is the old folks hour. I mean, oh my gosh.
Truth be told, there's a lot of people who, the cycles work needs a new generation. Wouldn't you say, Larry?
Well, I don't know, but I mean, you start with Sherman and then you go down to me. Now you're going to have these young kids coming in here next after us old guys. But right. Sherman, man, what a legend he is. I remember Sherman when I was just a kid, did Channel 22 in Los Angeles in the 40s or whatever it was. But it's a real honor to be here and especially to follow Sherman because he's a legend. And I think Tom was just a button in his eye when I first met Sherman. So now to see his son take over.
And Sherman didn't mention the McClellan oscillator, the McClellan financial report, but Sherman and his son Tom produce an astonishing service where they use their indicators and some cycles work and seasonal work. I follow it myself. It's wonderful stuff. And
Tom is really interesting that he covers a whole lot of information in his reports. He's, so many people just get focused into one thing. And Tom is the jet fighter pilot by training, but he's really brought a lot of attention, some great work. He's just followed in his father's footsteps.
I didn't know that about Tom. And we're talking about Tom McClellan, Sherman's son.
Yeah, he's a truly remarkable guy.
My dad was a fighter pilot.
Oh, yeah? Oh, you have a lot in common.
Born in the Air Force.
Well, let's start. I've got a lot more PowerPoint slides than we originally were talking about. So to me,
take it away.
I'm going to be the kind of the the doubting Thomas. And though I use cycles and I believe in them, I still have problems with them. So to me, it's the good, the bad, and the ugly. And I think everything in life cycles. You know, we're born, we grow, we mature, we die. Doesn't matter if it's a tree or a mushroom. Everything cycles, or at least certainly it appears to cycle. So, cycles are there. They're every place. The good is that there's a tremendous number of cycles, but this is a really big takeaway, I think, for traders. The only cycles that matter are the ones that fit the time frame you trade. If you're a short-term trader, forget a 39-month cycle. It has no relevance to what you're doing. So all other cycles are meaningless. Forget about all the abstract stuff. Whatever your time frame is, maybe you're trading a 39-month guy, you're for a long-term guy, well then work on those cycles. But to really make cycles work for you, you've got to use the ones that fit the time frame you trade. And until you figure that out, I think you're gonna have a lot of confusion with cycles. They're so fascinating, they're so interesting how they come in and come out and they make some remarkable calls and failures. So find the one that fits your time frame, and then you're going to really be able to jump speed your own trading with cycles.
That's such an important point, Larry. Thanks for bringing it up. And skepticism is welcome here. We don't have all the answers for cycles. You know, that we are the foundation for the study of cycles, and we're here to, not to pretend they're a panacea, but to study and learn about them and discover more and discover how to better use them.
Well, and I think that's good. When people are always introduced, say, "Oh, I wrote all these books," and he's had all these, hundreds of thousands of readers. I was think, wow, how many lives did those books mess up? Because this stuff was not for everybody. It's a really, so
Great point.
yeah, skepticism is good, and we'll get to a little bit more of that a little bit later on here.
Sounds good.
I think a big takeaway that people forget is that cycles are a function of time more than magnitude. Amplitude, the height will vary because markets will go into trading ranges, not move, and have huge moves. So the amplitude varies all over the place, but 33 days is always 33 days or whatever the cycle is. So cycles reference the time that a market should have a move up or down, but it doesn't tell us necessarily the magnitude. It just says, oh, we're at a 52-day low, whatever the cycle is, or 9-day low. But it doesn't tell us, oh, we're going to have a huge up move here. It just says, there's something going on here. We may have a market bottom at this point. So they can suggest areas, as I see it from my trading of highs and lows. They might suggest how long a trade can last. Clearly, if you're trading a 9-day cycle, you're probably in for a 4.5 to 5-day move. If you're trading a 57-day cycle, you might get a 25, 30-day move. So they may tell you how long the cycle will last. If you're getting into a cycle now of X number of days, no guarantee, of course, but it may tell you, oh yeah, we should have a decent move here. We still are lacking the amplitude. I think what makes cycles work is that they set up for some event to happen, and the news of the day makes the magnitude of the move. So I don't know how to predict the magnitude of the move with technical analysis. Maybe only one indicator of all the stuff that I have developed or read and seen over the years. The magnitude of the move is a problem because that's where you make your money. You don't make your money on the time scale, you make your money on the price scale. So we can get set up with the cycle stuff, but still the magnitude, is this a little trade or a nothing trade, comes from other stuff.
Yeah. They're
So,
directional, would you say?
Yeah, it tells, well, we should have a rally here, but we don't know how. We may have an idea how long it will last from cycles, but still magnitude, we don't know.
Yep.
I think cycles cannot predict exact or even close to high and low entries. To me, they're a general tool. They don't predict exactly where price will go. They'll give you a general area. To me, they're a tool. You could give a pencil to anybody that's listening to this today, and we could all write out our name and draw a circle and stuff. And somebody really talented could do a beautiful piece of artwork because they use that tool better than we do. And I just haven't been able to figure out exactly how to use this tool, and I'm slow enough that I go, well, it's a tool. I'm just going to take it as a tool, and I don't know that I can refine it. I've seen people try to refine it, and I don't see a lot of great successes. But it's a wonderful tool. but let's not try to make it more than what it is. And I think it really gets down to God doesn't want us to know the future. We're really going against God here.
Wow.
We're not supposed to know the future, guys and gals. And so, yes, it's tough to know the future. So you got to keep that in mind too. I see all these people on the internet with all these claims if you can know the exact highs and lows and all that stuff. And I don't know. I've had millions of trades in my life. I've got out of the exact high, maybe 3 times, exact low 4 or 5 times. Law of average, I should have done a heck of a lot better than that. And I'm not bad at doing this. And other traders I know were better than me. It was the same thing. We never get the highs and lows. That's marketing. There's a difference between a marketing guru and a market guru. You got to be careful of that in this business.
Yeah. And Larry, I don't want to get into a theological discussion, but I think God lets us know a little bit about the probabilities of the future.
Yeah, God gives us a glimpse.
Yeah,
you bet. But we got to figure it out from there.
The odds in our favor.
Yeah, exactly. And he gave us intelligence. So I'm going to get to work. I'm going to show you some cycle studies I've done. I'm going to be using the foundation cycle software and the one I'm most familiar with, Timing Solutions. And I'm seeing some interesting things with the 2 of them. So I think the more tools you have, obviously, the better.
Great.
A little historical perspective. I first got involved with cycles in 1964 with a guy named Parnell McKenna and something called the Society for Investigation of Reoccurring Events. And Parnell was in that, Art Merrill was in that, and W.D. Gann's son was in that group. And I would go to New York City. I lived in Carmel, California then, and meet with these people. And I was able to be with, some of the legends that have passed away now. And it's really interesting to have that background and to acknowledge probably the first thing done was Benner's prophecies on long-term cycles in the 1800s. W.D. Gann used the Bible a lot. I got to know W.D. Gann's advance man, F.B. Thatcher, who was in Santa Rosa, California. We wrote so many letters back and forth, and I wish I would have kept them. I never realized at that time that this was part of history. FB traveled with Gann. He was a promotional guy. And he said it's all about the story of Noah in the Bible. The water coming up, the water coming down is an allegory for stock prices.
Mm-hmm.
And so I thought that was interesting.
A lot of these people still with us and presenting this week, Larry. Jake Burns.
Yeah, some of us are still around. Yeah.
And Yale's son, Jeff, is also presenting this week.
Edgar Lawrence Smith did probably the first really serious academic work with cycles. Warren Buffett said basically he's one really smart guy. And Edgar Lawrence Smith did the decennial pattern and a lot of work on valuation as well. His work has been instrumental in my understanding. Of course, Edward Dewey, I started reading the Foundation for the Study of Cycle stuff. Well, I don't know, it was 1964 or 5, something like that. You're reading everything that Gertrude ever wrote, and I'm fast like, wow, maybe we can get a view of the future.
Yeah.
Along the way, I met Yale Hirsch, and Yale and I became friends, eventually business partners, and something not to do with the markets. And of course, I knew Jeff when Jeff was just a little tiny kid. He and his dad came to Montana, and I took Jeff trout fishing at our cabin in Montana. So I've known Jeff since he was maybe 6 or 7 years old.
Yeah.
And he's added a lot. And Yale, oh my gosh, the work Yale did is just legendary. So I've learned a lot from these people. Yeah. Then Jim Hurst came along with the magic of profit of stock market transaction timing. He added a lot. And then after that, a whole bunch of us, Jake, Peter, Proctor, Stan Ehrlich, all these other people kind of followed after that. So that's kind of the history of how this all has developed. At the same time, though, the foundation has consistently been there. That ups and downs like everything, but the foundation has been there as kind of a backdrop to keep this whole idea of going. And that's why I encourage people to be members of the foundation, keep this stuff going. So here's the big thing. When Richard and I were talking last week, it was, well, what causes cycles? Why do we have them? And I'd like to try to address that. I think events can cause cycles. Fed policy causes a business cycle. Clearly, if you look at the history of interest rates get lowered in the fall for agricultural purposes and for Christmas sales. And we tend to have a rally in the bond market because interest rates are lowered at that time of the year. So there are some natural phenomena, like every 3 months earnings are reported. So guess what? There's a 90-day cycle in stock prices. So there are things that cause what appear to be cycles. Crop reports are released about the same time each year. So they have an influence. There are natural things that you can look for and think about. Oh yeah, that should, a repetitive event in the marketplace probably has an effect. And then I think with Shakespeare, somebody said these things are in the skies, or are they in the breast of mankind? They might be in the skies. They're probably natural cycles. There's clearly lunar cycles. I've traded a lunar cycle. There's solar cycle. You have seasonal hot and cold cycles. And the problem is there's just enough data you can, one of my favorite sayings I used to teach is that you beat the prisoners of war often enough, they'll confess to anything. And it's the same thing with data. If you beat it up enough, you're going to find every cycle you want. So you have to be very, very careful of overworking your data. I think this is one of the most interesting charts that you'll ever see. This is a deviation of moving averages of the Dow Jones Industrial Average. That's in kind of the gray line, and the dark black line are the solar cycle. They correlate pretty well. So they're not perfect, but if you're looking for a cause, I think the solar influences, I mean, obviously it gets hot and it gets cold. That's going to influence people's activity and their behavior. So that's one thing you might look for as a potential cause.
Yeah, this chart isn't current, right? This goes through
This
like,
is not current, no, but I continue following the solar cycles, and they pretty much they're still pretty reliable.
yeah, and we're going into kind of a solar minimum right now, right?
Yeah, oh yeah, that's why we haven't seen a lot of global heating. Solar cycles are way low right now.
Yeah.
So here's another chart with GDP in gray, not the market, but GDP. And again, we see, yeah, there's some action going on there. I think it was Henry Wheeler wrote about this, the professor at the University of Kansas years ago. But the one that's the most intriguing to me is a report from the Federal Reserve Bank of Atlanta called Geomagnetic Storms and Stock Prices in October 2003. This is really fascinating stuff.
I haven't seen this before.
This is sunspots. The cause, are they caused by geomagnetic storms? GMS and geomagnetic storms. And now we start to see, yeah, sunspots are the dashed line and geomagnetic storms are the solid line. And yeah, yeah, you bet. There's clearly a relationship going on when we have geomagnetic storms, solar storms, and yeah, there's a relationship there. Of course, I got to get real here. Can we make money with this? We're traders after all. So the Federal Reserve showed this in their paper, and it's really fascinating. The blue bars that you see are days prior to having storms, and the 6 calendar days after a storm, they call bad days. I'm going to see if I can put my mouse over here. Yeah, these are the bad days, and these are the other days. What a difference. The 6 days after the geomagnetic storms don't do very well. That's the New York Stock Exchange, American S&P, NASDAQ. Like, wow, yeah, there is some reality in there. Geomagnetic storms, based on the Federal Reserve System, do have an influence on stock prices.
How long ago was this paper published?
2003.
I wonder if it's been arbitraged.
Well, we'll get to that. I've done work with that. Then they looked at all stock markets throughout the year, throughout the world: Japan, Australia, New Zealand, South Africa, Germany, and we see pretty much the same thing. The brown bars aren't as high as the blue bars. So if you're looking for cause, that could be the cause. Now, the problem is, okay, we got the data. We know when there are geomagnetic storms. Going from here into a mechanical trading strategy, which I worked on, marginal. There's an influence there. It's like there's a lunar influence, but converting that to a successful trading strategy, I haven't been smart enough to do it. Maybe somebody else will, but I haven't. So this is a picture of President Reagan and I, myself, when I was running for office. And I love what Ronald Reagan said. He said, trust but verify. This is what you got to do with technical analysis, fundamental analysis. Look at all this data, trust all this data, but guys and gals, go out on your own, verify this stuff. Don't take my word for it or Richard's or anybody, because if you verify it, you'll own it and you'll become a much better trader and you'll understand this stuff much better. So verification is a huge process. The best way to learn something is not to just read the book, but to read the book and teach it to somebody else, and that's when you'll learn.
Mhm. Mhm.
So to me, there are two types of cycles. Everybody's focused on time cycles. That's what we've been looking at, right? But I think there are other cycles as traders that I look at, price cycles and magnitude cycles. So those are cycles you don't think of. I'll take a little bit look at that. A price cycle would be we cycle from small ranges to large ranges. So if you're in a large range situation in the market, you've seen a lot of large ranges, like, wow, this cycle is going to end. We're going to go to small ranges, which means as a trader, I like to see a lot of small ranges because I will then go to large ranges where I might be able to make some money. So I think there's a cycle to small ranges, large ranges. And the way markets top is the close to the low is very large. The way markets bottom, the high to the close is very large. So there's a natural way markets cycle. When as a market starts to move up, the close goes higher up in the range, higher up until the range, until the market's closing just about on the high, cycles over. Now we're going to come down, and the close will be up in the upper part of the range, mid part of the range, lower part of the range, on the low of the range, on the lower range, or to cycle low. So there are price cycles that I deal with, not just time cycles. And of course, you obviously figured out what I want to do is try to combine both of them. So what I've learned is there's no perfect cycle. Once you find one, it changes.
Yeah.
That's been my experience. Long-term cycles hold up, but they're general. So here's how I find a cycle. You can do it with the Foundation for a Study of Cycle stuff. There's a lot of software out there, but this is the old-fashioned, this is the old man way of doing it. I just count the number of days. Oops, go back a slide. From this peak to this peak was 50 days. From this peak to this peak was 24 days. From here to here, 36 days. From this peak to this peak, 43 days. From here to here, 57 days. From here to this peak, 36 days. From here to here, 50 days. So I had a pretty good idea of how the peak to peak count in a market, or you could do low to low, it doesn't matter. Here's looking at low to low. We had a significant low here and here, 40 days from here to here, 26 days, 48 days, 39 days. So when's the next cycle low coming? And what I do is I just take those cycles, in this case was 525 days, and we had 12 examples. So we're in about a 43-day cycle. So about 43 days from here, we should see a market low point. So that's the easiest way of doing a cycle.
That's the basic cycle analysis for sure.
What I found interestingly in 1967, I don't have a chart of it here. I don't know if I can draw on this or not, but I'll try to explain it. If you take this high to this high and take that distance from here to here, subtract and add to this low, you're going to get a general rally in the market. If you take this low from here to here and add to this high, you're going to get this peak over here. If you take this peak and add to this low in between, you'll get this low. So I found that a peak to peak added to the low in between also shows where the next cycle low is. I should have put a slide in here to identify that. If it was not clear, people can ask questions about it. Okay, so now, of course, we have computers and all this. Before we were doing by hand and we didn't have adding machines, we didn't have calculators back then. So here is a good example from the Foundation Cycle program. Notice this was in November 2018, and this is the cycle forecast. It says 34-day cycles, the most active cycle forecast. The shaded line is what actually happened. Now, this is out of samples, so we did the cycle forecast here. We didn't know what would happen. So it was pretty good on this rally, pretty good on this decline, a little early for this low, decent buy point here and here.
What market is this, Larry?
This is stock market.
Okay, like S&P 500?
Yeah. Mm-hmm. Okay. So, oh, great, we're in a 34-day cycle. Well, then we go into the coming year and we go, oh, now we're into 173-day cycle. I don't know what happened to the 34-day cycle. It went bye-bye on us. It boogied out of the room. So now we're into another cycle. And again, we see, oh, well, it didn't call the low here. It called the high. It did get this low. Pretty good over here. We should have had a low here and we had a high. So I think you have to adapt or add these together or use other stuff to do it. So then again, I ran it again, and then we go into just before 2020, and we're back to a 33-day cycle. So, oh, well, maybe that's interesting. We've seen 34, 33. Maybe we can find a consistent cycle. It didn't hold up real well in the future, though. We should have had a peak down here, and instead of we had a bottom, we should have had a sell here instead of we had a buy point. We're getting into a sell area for it now. So again, there's no magic to this. You know, it drives me crazy. People will talk about Gann or whoever, and they have this magic formula, and they could tell the market in advance for 10 years. If that's really true, then you'll also read articles about W.D. Gann flying around the country in his airplane to check crops to see how the crops were doing. Well, think about that. If you had something that could tell you exactly in the future what was going to happen, why would you go inspect the crops? You wouldn't have to, would you?
Right.
So then just before the peak that we saw this year, the cycle changed to 180-day cycle and actually held up pretty well. It didn't call the bottom, but it's 180 days. It called the nice rally we saw over here. So it is the work of art. This is something that I have worked with a lot. I don't have the answer for it. My great and very, very dear friend Jake Bernstein said Lars at the Foundation for Study may have some solution to this. I'm looking forward to hearing that.
Yeah, we'll be highlighting how to use this tool over the course of this week and doing some questions on it. And you know, the dominant cycle it's just the cycle, the one cycle that's the strongest in the data at the time that your sample ends. But there's lots of different cycles, and like in Sherman's presentation earlier, you know, we were making composite cycles out of half a dozen strong cycles, and they all kind of work together to ultimately create a forecast. But you know, sometimes like they do seem like magic because they work so remarkably well, and other times, you know, they stop working. You have to be vigilant and support cycles with other tools. But I do think they're really
well, the perfect world would all make money, but they can give us a little glimpse. Yeah. Now here, back to the 30-day cycle. Wow, called the low, called the next buying opportunity. Has a buying opportunity coming up here. We've seen the market real strong now. Looks like we have a peak in July. So I update this stuff and I look at it and then I try to make my best guess. That's really how I use this stuff. And here the dance continues. Now we're back to 171-day cycle. So about the middle of July, it looks like we're going to start to come down. So then it's common sense. Well, what are the commercials doing? What's the advanced decline line doing? What are the other fundamental things doing? What's the bond market doing? I kind of put this all stuff into, okay, I've got some reference points here. What's rest of the stuff suggesting here? Because I want this stuff to be confirmed. So I just did a July 9th, I'm sorry, June 9th forecast where I combined cycles like Richard was just talking about. And this looks like about what should happen. We come up after July, and then we start to come down into a bottom in October just before the election. So
that won't be good for Trump.
Yeah. Well, there's Richard. People talk about the election cycle. I'll show that in a moment. But also stocks, it doesn't matter which dirty dog we elect. Stocks rally at election time. Yeah. It doesn't matter if it's Republican, Democrat, or whatever. There's some real strong short-term trades right at election time.
Everybody's relieved that the thing is over.
Yeah, it's like, oh, I don't have to, no more ads. And we all have a sense of, oh, we have a new leader and, you know, he's going to be positive and, you know, so let's move forward.
That's a good cycle.
Wow, that'll be interesting. Whoever wins this year will be as old as Sherman or Larry Williams. That's going to be a real old timers affair. Hope those guys are in better shape than Sherman and I are. Yeah. So long-term forecast, I think are of academic value only. And I'll show you why. We're going to look at some long-term. This is a long-term forecast, 213 days. And the top came over here. It was a little early on the top. You would have been selling in here. The bottom says to get bullish over here, but the bottom was here, maybe even here. So real long-term cycle forecasts, I think, are fascinating, but I don't know that they're of great value. Again, maybe if you're a real long-term trader, they are. But here's now we go out to another, we get 217 days, and well, the peak should have been here. This is the 2018 bear market, and the peak came early. Bottom, oh, we should be getting into a low point over here. Well, the low came real early. So, well, clearly there's a 39-month cycle in stock prices. I don't know how to make it work for me other than give me a background. So I'll quickly look at Timing Solutions, another software to establish the exact same points I've been talking about. Long-term cycle, 43-month cycle. This was done in 2009. And if we look at it, my mouse over here, pretty good peak, trough, peak, trough, peak, 2008, call it 2008, 2009 bear market, pretty darn well. Forecast what's happening. So, hey, maybe we found the 43-month cycle. And this is how it came out. Well, you should have had a peak here. You didn't. The bottom here, maybe. A peak over here. Well, you didn't. A peak here. A buy point here, and you're closer to a high point. So
Right.
I think that they're fascinating, of academic value, but to try to make any investment decisions off these real long-term cycle forecasts, I don't know. Currently, I think the most dominant cycle using Timing Solutions has been about 71 to 80 days. And when I look at foundations, we're coming with 33, sometimes 71 days. So all this stuff can kind of zero in on about the cycle of the marketplace, or you could do it by hand as I showed you. Interestingly enough, this also suggests a little after the 4th of July, we could start to see some down move in the marketplace.
Mm-hmm.
So that also starts to confirm. And this is a combination, which is what Richard was talking about, not just one cycle, but I forget what cycles I have in here. It's probably a 80-day cycle and a 45-day cycle or something. But we can start to get some commonality of, oh, okay. So again, to me, no magic to this stuff. I am not good enough to make a mechanical trading strategy out of any of this. Besides, I'd prefer to be a discretionary trader. So from my real trading, and I really trade hundreds of contracts, I'm not just a 1 or 2 lot trader.
Yeah, and your website is ireallytrade.com, right?
Yeah, and both my wife and I trade at a substantial size. And what
Yeah.
my takeaway points are: cycle forecast models do best at spotting lows. And go
Is
back
that
and look at
primarily in the stock market or in stocks and commodities?
and anything. And here's a good example. We should have a market high here. Well, we don't. Well, we had a good buy point here. We had a good buy point here. We should have a sell here. It wasn't much of a sell. Oh, this sell was pretty good, but how about a big sell here? We should have, if you just look at cycles, gone from here all the way down to there. We didn't.
Right.
But good buy point, good buy point, good buy point, good buy point. For whatever reason, I think they're best helpful at lows because we bounce off those lows. But tops, you might get a cycle high, but it just grinds out or it goes flat and it goes, and then it takes off again.
Right. I think it's partly that there's an overall bullish, trend.
Well, if there is, tends to be that perpetual drift. But when I look at individual stocks, same thing. And when, I trade gold a lot, I trade the energy market, I see the same thing there.
Mm-hmm.
Peaks and valleys and cycles only tell us the price will falter there. It says, okay, we're in the area of a top, but we may go down, we may go sideways, we may just lack any movement for a while. We're going to hold there, or we may come down. But it's like I talked about earlier, just because we're at a cyclical high does not mean you're going to have a big decline. It's the news of the day, the fundamentals of the day that caused the magnitude of the move. So these price points will not necessarily go up or down. It may, but then again, it may not. We need fundamental or technical confirmation. I would never buy just because there's a cyclical low or sell because there's a cyclical high. It's an alert it's like a flashlight. Like, oh, wow, wake up, Larry, something's going on here. That's
like look over here.
yeah, you better focus on this market.
Yeah.
So another way of looking at all this is the algorithms. Paul Tudor Jones, 1929 was like 1987. So here's an algorithm of from the past. This is the 2019 big market slide, and this was the year that best matched from the past. Pretty good. Buy point here, big slide, come down, and then the market came up like that. So it looks like, yeah, there's an algorithm from the past, and this is how it held up. Not really good. It was okay for a while here, but then, we should have continued going up and we didn't.
So that was some period from the past market, then trying to use that to kind of map out what would happen in the
Right. This was from, I don't know, 15 years earlier or whatever.
Right.
And should that hold up in the future? I'll go back to that. And my experience with these algorithms, they're fascinating and they don't hold up. And I have done, thanks to timing solutions, you can do that in timing solutions. One of the unique things you can do there. And I can't get them to hold up. And I have, I don't know how many countless hours I worked on this trying, oh yeah, if I can get a real close fit from the past, I'm going to know the future.
Right.
And I can't.
After, 50 years of I really trade hardcore experience, you have concluded God doesn't want you to know the future.
Yeah. Well, she wants us to see a glimpse of it. That's about it.
See a glimpse and
a glimpse.
And you are making money or you wouldn't keep doing it.
Oh yeah. That's why I'm retiring at the end of this year. So my wife and I can just trade. So there are a couple things I have found that I do like in terms of cycles that have been fixed over the years. This is a 65-week cycle. It's certainly not perfect. This is the 2008 bear market. Got this slide really well, caught the low pretty well, got some pretty nice bounces in it. And you can see how that's continued working. There it was for this year, pretty close to the low in it. There's a peak in it, the low in it, peak in it, low in it.
Those are more than just a straight 65-week sine wave. What else is going on in there?
I don't know. It's just basically we're measuring a 65-week cycle. That's all that it is. This is nothing fancy. I don't have any background in math. I'm an art major with a journalism degree. So I got an idea and I gave it to my programmer, and that's all this is. It's just like a 65-week oscillator of prices, really.
Okay, great.
I'll show you some other interesting stuff. Well, in 1970, I made my first real killing in the market. I made $1 million trading as a young kid. Man, I thought I knew everything, but I didn't, because I didn't cover my shorts. I was short in here real heavily, and I didn't cover my shorts till here. And I got, what did I do wrong here? What am I doing wrong? Yeah. And I went back to when I first started trading in 1966, 62 period. And I remember 62 low. That was caused by John Kennedy rolling back steel prices. And I'm full-time trading in 66 now. And a 66 low was 4 years after the 62 low. And 4 years from the 62 low was a 1958 low. And as I'm licking my wounds, not getting out in 1970, so look at that. There was 4 years from the 1966 low. It seems like we're getting lows about every 4 years. And this is carrying it on into the future, or at buy points about every 4 years. There's been some really nice buy points in the marketplace.
Yep.
And carrying that forward, it started to shift a little bit, not bad. So you probably want to go to the last 4-year low, like 2008, and come forward 4 years, or come forward 4 years from any significant low. So 4 years, again, it's academic. I'm not going to buy just because of a 4-year low, but that's certainly one time frame that I pay attention to.
Thank you. That's great.
You had mentioned seasonals with Sherman a little bit, and I do want to wade into that a bit here, Richard. In 1973, I wrote Sure Thing Commodity Trading: How Seasonal Factors Influence Commodity Prices. This first book ever written on seasonality and commodity prices. It hadn't been done before. It started this whole cottage industry. Everybody has seasonal patterns now, and I really made some major errors in that book. I'll get to that in a moment. There's a real reason that we may have seasonality, because we have crops that are harvested and planted at the same time of the year. We have consumer demand for jewelry around Christmas. So there are real reasons why we should see some repetitive action. But I've learned that seasonality is suggestive, but it also, unfortunately, is not a be-all, end-all. But if you're using cycles and you're trying to find a good cycle, wouldn't it be wise to add the seasonal cycle of about 250 days
That's
into
about
whatever
1
cycle?
year of trading, right? Are you talking
Yeah,
count trading days?
yeah, those are counting trading days.
Yeah.
And I just use trading days in my counts. That's what I prefer. But you know, to give you a little longer term view, I think you're going to find it helpful to add what would be the seasonal pattern of about 250, 255 days to whatever
Mhm.
cycle studies you're doing. So that might be of some help. But these seasonal shift, this is the Dow Jones Industrial Average going way back to 1959. Now we know the phrase now is sell in May and walk away, right? Well, the
Right.
seasonal pattern in 1959, hold on, call the cops, look at that. You want to buy in May and walk away. That
Mhm.
was a seasonal pattern.
For
And
over how many
for the
years?
Dow Jones Industrial Average from 1900 to about 1960, the seasonal pattern was to buy in May and walk away.
Okay. Got it.
And about the time the Federal Reserve started to get more active in the economy, we started to see a seasonal change. Now, here's what I did wrong in my book, and everybody has followed my error. I finally woke up a few years ago and realized what I did wrong. If we look at us, well, let's go to this is a seasonal shift. This is where we are. This is the seasonal pattern now. And there's the October low everybody talks about. Here's the sell in May and walk away. What I learned is all the seasonal patterns that we see on everybody's charts now, even my good friend Jake Bernstein's, is the same pattern. The market shows the same seasonality this year as it did 20 years ago, because
Mhm.
we take all the data and then we force that data back in time. But 20 years ago, we didn't have the current data. So we're showing today's seasonal pattern on data 15 or 10 years ago when we didn't have the data. So I came up with a true seasonal pattern that only looks at what we knew up to this time point, up to this year. That's all we know. And that's a huge difference in seasonality.
Hmm.
Because if you go back to research seasonality with the standard form that I came up with that was totally wrong, that you're going to see, yeah, the buy-in every October. Well, they didn't work in 1959 or 60. So my seasonality only looks at data we knew at that time frame. And
I'm not
that
quite
is
sure
a
I follow, Larry. So the
pardon?
blue, I'm not quite sure I'm following
Sure,
you.
good, okay.
So this is the blue line we're looking at here is kind of the average behavior of price over some period of time, right?
From the last, yeah, in this case, this is Dow Jones from the last 90 years.
Okay.
Mm,
From 90 years of the Dow.
right.
Now we
And
want to
here,
know what's going to happen,
so
in
that's
20.
generally what has happened in the last 90 years. The markets generally, this blue line is generally what price has done.
Right. Sell in May and go away, right?
Right. But in
That's
1959,
right.
using data up to just that time frame.
Yep.
Now, what
Okay.
everybody else does is they'll take this vision here, the blue line,
Right.
and push it back into the past.
Oh, okay. I see what you're saying. So if you want to look at 1959, you only use seasonal data up to 1959.
Only data up to that time frame. Yeah.
Okay. Got it.
Okay. Oh, well, the election year cycle. Of course, the Yale Hirsch popularized this. Oh my gosh, what a gold mine Yale Hirsch's material and his research has been. I've made a little twist. This is the forecast for this year, by the way.
Yep.
What
Not everyone
I,
knows there's a pretty common pattern in election years of what the stock market does.
but you got to be careful.
Yep.
I only go back to the last X number of cycles. I don't think the cycle is the same back in 1940 and 1930 as it is now.
Mhm.
So I don't take all the data. I take a good sample of the data, but I don't use all the data. It's pretty good. March 6th is a pretty good time to start buying stocks. So was May 18th. So
In
that gives me
presidential election years.
a general roadmap of the recent election years. Yeah. And I think, I don't know, we can call that a cycle, Richard, a pattern. But we always refer to it as
It
the election
reoccurs
cycle.
every 4 years, right?
Yeah, and it's a 4 years. So again, it's the election cycle. So there's, and you can see that's my forecast for the year based, but I use a little different.
That's over 30 cycles or 30
Well,
years?
I do some other things with it, but basically this is from my forecast that I did in January this year. We do an annual forecast every year. And
Yeah.
I didn't know what was going to happen, but that's the election cycle forecast.
Yeah. Okay.
This is my 2020 forecast. You can see what we're looking for, a down move, and then that's the general forecast of what we're expecting for the year when cyclical highs and lows should take place. This is, of course, this was unknown. And
high about right now.
yeah. So what the most intriguing thing to me, on March 15th, we sent out a special major stock market buy signal. I got bullish because it was time of an extreme panic. I have a panic indicator and it got way into the buy. People were crazy. We were out of panic. And
Yeah.
here's the panic indicator. And then my question is, are there cycles to market panics? This would be a huge one if we knew that the public got emotional panic every X time frame. So I've marked off for everybody to see all the buy signals from my panic indicator going back to the 1930s.
Is this an indicator that you publish, or this is proprietary?
It's proprietary.
Okay.
So there was one, there's one, there's one, there's one, there's one, there's one. We don't get one till over here. So it doesn't seem to be any there. We had a lot of them in here, and then we don't get them, and then we get them. I have not found, and then we got one here in 1966. And coming forward, we're kind of similar here, but then we get dissimilar, then a long time frame, short time frame. 1987 nailed it, short time frame. And this is coming up to date. And so there's a long time frame, short time frame, a nice panic signal in 2011. And then we got one in the middle of March this year, a long time from a panic. So,
and you hadn't seen one for 10 plus years.
I hadn't seen one since 2011.
Yeah. Wow.
So I think I can't find a cycle in panics. It looks like people panic when stuff happens, but it doesn't seem to be any regular basis to that. Now the indicator is pretty good, but going back to Clint Eastwood, in Two Mules for Sister Sarah, he said that was no miracle, just an accident, and life was full of them. And that's like using cycles. Sometimes we get really lucky, like this call in March to buy right at the low. Just a couple of days when I actually bought the absolute low of the market. But it wasn't a miracle. It was just an accident. You got to be careful as trading. Life was full.
Well, I don't know if I'd call it just an accident, but
it was an accident. I got lucky
there, Larry. You wouldn't have moved panic index if you hadn't seen one before.
There was stuff there, but sometimes in all this data stuff, sometimes you just get lucky, and I, that's wonderful to get lucky. But I think Clinton, he said it pretty well, good here. It's just an accident, and we get life's full of good accidents for us. So I don't see if there's any consistent time pattern when panics take place. Now, I think another presenter is going to get into panics, and they may have another conclusion. That's what makes the markets. If we all agreed, the markets would never move an ounce of spit. So that's what makes it so fascinating. I do like to use forecasts of the one market versus another. This is a crude oil forecast. The blue line is the price of crude oil. This was published in my report, chart number 6, my report earlier this year. And this is what stock price should do based on crude oil. And you see, well, we did bottom, we came on up, and it's pretty well followed.
What period of crude oil was that?
I don't recall. And here's the problem.
Sherman showed about a 10-year lag on crude oil.
Yeah, I use shorter than that because I don't trade on a 10-year time frame. But the problem with these intermarket forecasts, I try to base them on the current cycle, but sometimes, crude oil dominated the news this year, didn't it? So it has much more impact on stocks this year than maybe a year ago. When interest rates were really high during the Jimmy Carter era, stocks were very predictable by bond prices in advance for about 180 days. Mm-hmm. So whatever's topical of the day, sometimes it's dollar index, sometimes it's crude oil, sometimes it's gold. Gold's been really good recently. Sometimes it's Fed funds. Fed funds have been great recently. So these things shift around. Again, It's a lot of work to do this. It just, but it's an idea that I hope people see and can apply and open up their minds. Because I said, I'm no math guy. I can see things, I think maybe because of my art training, but hopefully people can take the few observations I've made and take them way past wherever I ever took them. So
All right.
this is a really interesting thing I did. I took what I think are the three most consistent short-term cycles. To make it simple, these aren't the values, but let's say you have a 10-day, 20-day, and 30-day cycle. Well, then you've got to weight them because the 30-day cycle is a lot larger. You need to have the 10-day multiplied by 3, so it equals a 30-day, and the 20-day weighted to equal the 30-day. So I took the three most current cycles, weighted them, and added them together. And this is the intraday forecast with this formula. This is a chart from 2016. And the red line pretty well.
Day lines, the dashed vertical lines are 1 day.
This intraday. This is from here to here is a day, here to here is a day, here to here is
Got
a
it.
day.
Okay, great. So
And this
cycles on short-term time frame.
right, and this predicts out 66 bars in advance. So all of this point was known 66 bars. It was known back here. This low was known, 66 bars back here. And
Okay.
it's kind of interesting. Here it is, the exact same formula on crude oil right now. I don't know what crude oil did. Oops, hold on. We just got one of my daughter's trades, my youngest daughter's trading, and we had a great move in the market today on the long side. She was calling me, sorry about that. So you can see how it doesn't necessarily give us everything, but it gives pretty good idea of what's going on. Now here's the same formula for right now. This was copper, and here's the formula, the exact same forecast, and copper came down and it started to rally today. So I think that there's some merit to this idea that somebody else can probably take a lot further than me. Here it is in 2020.
What did you use to
for
come up with these
E-minis.
cycles forecasts?
Pardon?
What did you use to come up with these cycles
Well,
forecasts?
the three, what I think are the three most dominant short-term cycles in the market.
Okay, got it. Yep.
And then add them together. I do some little weighting and some kind of fancy stuff, but it gives a pretty good idea. Here you don't know the magnitude again, right? But we're going to go sideways. We should take off. We should come down.
Yep.
It started with daily charts. Actually, I was doing started with daily. Now I was showing you intraday charts, right? But the formula I came up with was on daily charts on the stock of Apple. That's where I got the idea. And so here's Apple, and here's the same formula I did, I don't know how many years ago now, 12, 13 years ago. So Apple should start to rally in here and start to come back around the middle of July. So to me, it's an intriguing idea. Here's the Australian dollar. I'm long the Australian dollar. Well, guess why? Well, partially as the cycle forecast is we should start to move up here. It gives me a pretty good idea when to look for market highs and lows. But it's interesting to me, and here's another daily chart. This is corn. We've got long corn down in here. Trailing stop now looks like it's going to start to come down. You can see, again, this sell-off was known 66 days in advance, but I'm using the same formula on those intraday charts that we looked at. So Richard, somebody like you maybe can take this a step farther than I've been able to.
So you're taking your top 3 cycles, combining them into a
one indicator
cycle.
Yeah.
And forecasting it 66 bars into the future.
Yeah. That's it.
Great. Yeah,
that's
I'll check it out.
And a really smart guy, what they'd probably do is you'd run it like you can in your thing or timing solutions and get the three. I'm fixed into these time frames, right? The math never varies, but you get the current 3 most active cycles.
Or the time frame that you're interested in.
Right. Yeah, for your time
in the beginning of your presentation.
I mean, as a short-term trader, you're probably going to be interested. You're going to look at a time frame in the 18 to 25 day and the 45 day and the 70 to 80 day, and I'll add all those together and da. But that's an interesting idea. So here's a cheap shameless plug. If you want to see a lot of stuff, I've done a lot of stockcharts.com videos on YouTube. They're very explanatory. Why we got the buy signals and about the Federal Reserve, etc. Also, I've been on Jim Cramer's Mad Money a lot with some interesting comments. You might want to look there. Or I do my weekly market commentaries every week. But at the end of this year, I'm retiring, so there's 6 months left. That's it. And our website's ireallytrade.com. So let's wrap all this up. What does it all mean? I think there are many cycles. There are traders. You need to find the ones that fit your time frame. They're a tool. There's no magic to this, no be all end all. This is a thinking person's business.
I love that.
Get this information, try to put it together, and then, you know, I make judgment calls, and often I'm not right. So I have to, it's really, this is a business of making money, of learning how to be an effective trader. It's a lot more difficult in war to charge than to defend. Because to defend, I've got my bases pretty covered. But if I'm charging somebody, I don't know for sure what's out there in front of me. And in trading, we tend to be aggressive. We're charging, but you better have a defense mechanism. If you want to make money, trading is a totally different game than technical analysis and cycles and all this stuff. You have to combine those two things together.
I was, you and I talked a few days ago, and I brought up the book, The Zurich Axioms. And I was surprised to find out that that was your favorite book on trading.
Yeah, that's clearly my great trading book. So my daughter calling again. We have another trade for today.
It's been a good day.
Yeah. And that's interesting. Paige is started the trade last year. She won a 3-month Robbins World Cup Trading Championship in a 3-month contest. She's done okay this year, not knocking out of the park, but making money. So what intrigued me, Richard, is this can be taught. That I can transfer knowledge, or Jake can transfer knowledge, Sherman, Tom McClellan, we can transfer knowledge. This isn't this, I don't have any great unique skill to anybody else. I don't have any natural ability to do this. This actually can be learned and taught, and that's really encouraging.
What I hear you saying is that cycles are one of the tools, but that they're not the end all be all for really succeeding at making money in the markets.
Well, they might be, but I have not been intelligent enough to figure it out. Now, somebody else probably can do.
I don't think that's the issue. You know, I think markets do, you know, shift and move, and markets are anticipatory, right? They're, you know, it's a bunch of participants trying to predict the future and anticipate what other market participants are going to do. And that creates cycles, and they come and go, you know?
Yeah, and it's random. There's a big news announcement. This breaks out, that breaks out.
The fundamentals interfere with the cycles, as Sherman was showing us. You know, a lot of what the Fed's doing right now has disrupted a lot of very powerful cycles.
Well, and that's where you can combine those, and you see, oh, there's a cycle low, and now the Fed is doing something great. So it's like I said, this is you try to add these ideas together and come up with a decent idea, but even then, you better have stop losses and targets and all that stuff that traders live by.
It is pretty interesting to me now, hearing from both you and Sherman today, with all that both of you have accomplished in your careers, you are still involved with cycles.
Well, yeah, I've always thought from day one that cycles influence things. Could be a wrong belief, but yeah, I have found them helpful. When I was young, I thought that there was a perfect cycle, and I could find this cycle. I would have it all made, and you know, I'm still searching for it after 58 years, whatever it's been. And I haven't found it. And you know, a few years ago, I realized, well, Williams, you're too dumb to do it, or you know what? It's a general tool that fits in your. I use commitment to traders. I use valuation. I use cycles. I use seasonals. So I have a quiver of these arrows in there that help me set up a trade, and it's a great setup tool. But none of these on their own are be all end all. If I get commitment trader report, valuation of the market, and cycles, I go, I got a trade going on there. I better pay attention. So that's how I use this stuff.
Yeah, no, that's fantastic, Larry. That's how I use it too. And we can't separate the trader from the trade, you know?
Well, yeah,
wherever we go, there we are.
You're trading, yeah. We're trading our personality, and you know, it's all a wheel within a wheel. There's a great mystery here, and there's a beautiful song from the Thomas Crown Affair that I think Steve McQueen was in the first Thomas Crown Affair. There's a great song there about wheels within wheels and cycles. And I wish I could play the song, but it's a wheel within a wheel. And there's a lot of study, and I certainly haven't cracked any code, but I've got a little bit of a glimpse that's helped me as a trader using cycles.
Yeah. I think, let's see, somebody wanted to know if you, well, do you think black swans, do those concur with your panic cycles? Or do you even pursue the idea of black swans? You know, market events kind of out of the blue.
Yeah. So what a black swan causes the panic. So what we need to have is something that measures when the black swan is there. And that's really what my panic indicator does. I don't know that I can predict all black swans. I've been able to predict some of them, but not all. But I can predict when it has occurred by using measures of accumulation and distribution in the market. When the public was crazy selling the market, we had a black swan selling event. That would be a panic indicator.
Fantastic. Well, Larry, really appreciate you joining us today, everybody.
My pleasure, Richard. I appreciate what you're doing to keep the foundation for study for cycles alive. Thank you for doing it.
Thank you. And, you know, I'd love to work with you on some of these ideas and develop them further and, you know, continue to share them with the foundation audience. And really appreciate your honesty about your experience with cycles, because I think that's so important for people to understand, you know, because they can get quite captivating. You can be on, you know, the holy grail pursuit, you know, and I haven't found that to be the case either. In the end, you know, it's risk management, it's psychology, you know, and experience and good indicators of which cycles absolutely are part of mine. But, you know, we are at the foundation pursuing the mystery of cycles, and they are a mystery. And that's part of what the foundation's all about, is to better understand cycles, you know, not just in financial markets. We're focused on financial markets this week, but, you know, in all of our experience, you know, personal experience, as well as phenomena going on all over the planet, and to see if these are giving us clues to something that we don't yet understand about our world.
Well, I think even knowing about cycles, like I'm 78 years old, I'm saying, you know, it's time for me to cycle out of the markets, out of this public persona I've had. I mean, I've learned from cycles, they peak and they trough, right? So I can apply that to my personal life. I got very involved in some archaeological work years ago. It's you know, done a lot of interesting things. I said, okay, that cycle's over in my life, and I'm not going to go back to that. That cycle's completed. So understanding cycles, I think, can help us become more fulfilled individuals to go, oh, this is where I am in the cycle. I'm in a drawdown right now. That's just a cycle. I go through that. So it gives us some understanding and appreciation of our lives, which can help us be better people.
Couldn't have said it better myself. Well, Larry, thank you again.
My pleasure.
You know, go to cycles.org, and you heard from two of the, you got a century of experience today between Sherman McClellan and Larry Williams. Sorry, Larry. But
that's true.
Appreciate it. And folks, if you're not members of the foundation, please join. It's only $99 a year. You get access to our cycles analyzer and recordings of these presentations. And if you're already a member, we'd love to have a donation. We are a not-for-profit 501c3. And Larry, we hope to keep in touch with you in the coming years, and that you'll be inspired to, you know, share some of your experience and wisdom through the foundation. So thanks so much.
Good luck and good trading to everybody. Thanks for having me, Richard.
Thanks, Larry. Bye-bye.